You paid off your house, you threw the mortgage burning party, you shredded the paperwork, and for the first time in 30 years, you woke up owing nobody a dime for the roof over your head. It felt like the finish line. But here's the claim that's going to bother you for the rest of this video: that paid-off house might be quietly draining your retirement, and you won't see it happening because it doesn't look like a loss. It looks like safety. A recent survey of financial advisors found that nearly 40% of their retired clients have more than half their net worth sitting inside home equity they never touch, and most of them think that's a good thing. Here's what this video is really going to teach you: the difference between being safe and being optimized. Those are not the same thing, and confusing them is how disciplined, hardworking people retire with a $600,000 house and a $38,000 a year income that barely covers groceries and prescriptions. This isn't really about houses. It's about a much bigger lesson in how money that isn't moving is money that isn't working, and how to tell the difference between the house that's protecting you and the house that's quietly starving you. There are 3 things we need to walk through today. First, what debt equity actually is and why your paid-off house might be the least productive asset you own. Second, the real options for unlocking that equity: HELOCs, reverse mortgages, downsizing, and renting out space, and what each one actually costs you. Third, the honest trade-offs and risks of every single one of those options, because the internet loves to oversimplify this and somebody needs to tell you the truth. Stick with me, because by the end you're going to look at your own house completely differently. Part 1. What debt equity really means. Let's start with the sensation of it, because numbers alone don't explain why this trap is so easy to fall into. Picture your house as a vault. Every month for 30 years, you walked up to that vault and dropped an envelope of cash inside. You couldn't see it stacking up, you couldn't touch it, but you kept dropping envelopes because that's what a responsible person does. Then one day the vault door swings open. You see $500,000 stacked inside. And instead of taking any of it out, you close the door again and just admire it through the little window twice a year when you check your home value online. That's debt equity. It's real wealth, sitting completely still, generating nothing while the actual spendable money in your checking account slowly runs dry. A vault full of cash that you refuse to open isn't security. It's a very expensive picture frame. Here's the math that makes this concrete. Say you're 67 years old, your house is worth $520,000, it's fully paid off, and you have $180,000 in a retirement account, plus Social Security bringing in about $2,400 a month. Your monthly expenses run about $4,100. That gap, roughly $1,700 a month, has to come from somewhere, and right now it's coming out of that $180,000 nest egg. At that burn rate, without touching a dime of your house, you run out of money in a little over 8 years. You'd be 75, still perfectly capable of living another 20 years staring at a $520,000 asset you can't figure out how to use, sitting inside a house you technically own free and clear. This is the part nobody warns you about when they tell you to pay off your mortgage before retirement. Being debt-free is genuinely good. You've removed a monthly obligation, and that matters. But debt-free is not the same as cash flow secure. One survey of retirees found that homeowners over 65 hold roughly 45% of their total household wealth in home equity, compared to just 22% in retirement accounts and investments. Flip that ratio around in your head. Almost half of what you spent your whole working life building is sitting in a form you can't spend at the pharmacy counter or the grocery checkout line. Financial planners have a specific phrase for this: being house rich, cash poor. It's one of the most common financial pictures among retirees who did everything textbook correct. They avoided debt, they didn't overspend, they paid extra principal every chance they got, and now they're the ones eating cereal for dinner in a $500,000 house because moving money out of real estate has never felt like something they were allowed to do. The reason this happens is that we're taught to think of a paid-off house as the reward, the trophy at the end of the marathon. Nobody teaches us to think of it as an asset that needs to be actively managed just like a 401k or a brokerage account. Your house doesn't pay you dividends. It doesn't compound in a way you can access without either selling it or borrowing against it. Every year you leave that equity untouched is a year of opportunity cost, money that could have been generating income, sitting instead as square footage in a driveway. Part 2, where it gets interesting, the 4 ways to unlock it. So if debt equity is the problem, what's the fix? This is where it gets interesting, because there isn't one right answer. There are 4 real paths, and each one trades a different kind of comfort for a different kind of risk. The first path is a HELOC, a home equity line of credit. Think of it as installing a spigot on that vault instead of leaving the door bolted shut. With a HELOC, a bank lets you borrow against your equity as needed, usually up to about 80% of your home's value, and you only pay interest on what you actually draw. On that $520,000 house, an 80% limit gives you access to roughly $416,000 in credit. If you draw $60,000 over 5 years to cover shortfalls, and rates run around 8.5% on the amount drawn, your annual interest cost the first year might be under $1,000, climbing as the balance grows. It's flexible, it's relatively cheap compared to other borrowing, and you're not selling anything. The catch? It's still debt, the rate is variable, and the bank can freeze or reduce your line if your home value drops or your financial picture weakens. You're also on the hook for payments, which reintroduces exactly the monthly obligation you worked 30 years to eliminate. The second path is a reverse mortgage, specifically the federally insured version called a home equity conversion mortgage. This one flips the entire relationship. Instead of you paying the bank pays you, in a lump sum, a line of credit, or monthly installments, and the loan balance grows over time, secured against your home equity. You never make a monthly payment as long as you live there, keep the taxes and insurance current, and maintain the property. On that same $520,000 home, a 68-year-old homeowner might qualify for access to somewhere around $260,000 to $290,000 depending on current rates. That could convert into a monthly income stream of roughly $1,400 to $1,700 for as long as you stay in the house, directly closing that cash flow gap we calculated earlier. The trade-off is real. Upfront costs run higher than a typical loan, often 3 to 5% of the loan amount. The balance compounds over time and eats into what your heirs eventually inherit, and it only works if you plan to stay in that house long term. The third path is downsizing, which is the most direct way to convert debt equity into liquid, working money. Sell the $520,000 house, buy something smaller for $310,000, and you've just freed up $210,000 in cash before fees. Call it roughly $195,000 after a typical 6% combined transaction cost. Put that into a diversified income-generating portfolio earning a conservative 4.5% annually, and you've created about $8,700 a year in new income without touching your original retirement savings at all. That single move can erase most or all of that $1,700 monthly shortfall we started with. Roughly 1 in 5 retirees who downsize report doing it specifically to unlock cash flow rather than simply to reduce upkeep, according to Housing Transition Research, which tells you this instinct is already spreading. It's just not talked about enough. The fourth path, and the one people forget, is turning part of the house itself into an income asset without selling anything. Renting out a spare bedroom, a basement apartment, or an accessory dwelling unit in the backyard can generate anywhere from $600 to $1,800 a month depending on your market, all while you keep full ownership and keep living exactly where you are. It's the smallest structural change with one of the fastest cash flow impacts, though it does mean sharing your space, dealing with a tenant relationship, and potentially adjusting your homeowner's insurance and local permitting. Part 3. The trade-offs. Nobody wants to say out loud. And this is why it actually matters that you understand these aren't equivalent choices dressed up in different packaging. Each one is solving the same math problem with a completely different risk profile, and picking the wrong one for your situation can undo decades of careful saving. A HELOC gives you flexibility, but it reintroduces debt and monthly payment risk at the exact stage of life when your income is fixed and inflexible. If markets turn or your home value dips, the bank can pull that line of credit at the worst possible moment, precisely when you need it most. It's a tool best suited for someone with strong cash flow already, using the HELOC as a bridge or safety net, not as a primary income source. A reverse mortgage solves the monthly payment problem entirely and can convert your house into genuine income without ever forcing a move. But the compounding balance is real. Stay in the house 20 years and draw steadily, and it's entirely possible the loan balance grows to consume most or all of the remaining equity, leaving little or nothing for your children to inherit. For someone with heirs counting on an inheritance, that's a serious conversation to have out loud, as a family, before signing anything. For someone without that concern, it can be the cleanest solution on this list. Downsizing gives you the most cash and the most flexibility, converting a static asset into a working one almost overnight. But it comes with real costs that people underestimate. The emotional cost of leaving a home full of memories, the logistical cost of moving at 65 or 70, and the financial cost of transaction fees that can run into the tens of thousands of dollars. There's also market risk. Sell in a down housing market and you lock in a worse price than the number on your last online estimate. Renting out space is the lowest risk option financially, since you're not borrowing or selling anything, but it's the highest risk option emotionally and logistically. Not everyone wants a tenant in their basement or a stranger's car in the driveway. Roughly 1 in 3 retirees who explore this option abandon it specifically over privacy concerns, according to housing surveys on aging-in-place trends. Proof that the math can work perfectly on paper and still fail in practice if it doesn't fit how you actually want to live. Here's the thread that connects all four. Every single one of them requires you to make a decision instead of defaulting into inaction. The paid-off house doesn't ask you to decide anything. It just sits there, appreciating slowly, looking like an accomplishment. That silence is exactly what makes dead equity so dangerous. There's no monthly statement flashing a warning, no alert telling you the money inside is doing nothing. You have to go looking for the problem because the problem never comes looking for you. The payoff. Safety is not the same as optimized. So let's go back to that vault. Remember, the vault door was open the whole time. You could see the money. You just never took any of it out because taking money out of a vault feels like undoing something you worked so hard to build. That's the emotional trap underneath all of this, and it's worth naming directly. Paying off a house is an act of discipline, and disciplined people are often the most reluctant to touch what they built, even when touching it is exactly what the moment calls for. But here's the reframe that changes everything, and it's the whole point of this video. Being debt-free and being financially secure are two different achievements, and only one of them puts food on the table. A paid-off house protects you from a bank foreclosing. It does absolutely nothing to protect you from running out of spendable income at 76 while sitting on $500,000 of unused value. Safety is the absence of a bad outcome. Optimization is the presence of a good one. You can have all the safety in the world and still be structurally broke, month to month, because the wealth you built is frozen in a form the grocery store won't accept. The retirees who avoid this trap aren't the ones who take on reckless debt or sell their homes in a panic. They're the ones who treat their house the same way they'd treat a stock portfolio, as an asset with a return profile, a risk profile, and a role to play in a bigger plan, not as a monument to be preserved untouched. Some of them keep the house and open a modest HELOC as a buffer. Some convert to a reverse mortgage once they're confident they'll stay put. Some sell and never look back, thrilled to finally have breathing room in their checking account. There's no universal right answer here, and anyone telling you there is one single best move for every retiree is selling you something. What there is a universal right question. Is your house working for you, or are you working around it? If you've been avoiding that question because the house feels finished, paid off, done, a settled matter, this is the moment to reopen it. Sit down with a fee-only financial advisor who doesn't earn a commission on whichever product you choose. Run your own numbers the way we ran them here and figure out honestly whether that vault door needs to stay open a little wider. The house that once felt like the finish line might actually be the next asset you need to put back to work. If this helped you see your own home differently, do me a favor and hit like and subscribe.